Eric Johnston's with me right here. Your reaction to this, as I said, these things don't just drop out of the sky by accident.
Exactly. So the two things we know about the Fed is, number one, the market has been leading the Fed this entire way, and the market has been pointing more towards 75. The second thing we know about the Fed is that they don't like to surprise the market. So the last we heard, it was going to be 50 basis points. This article today tells me it's going to be 75. This was their way of sort of telling the market before Wednesday that it's going to be 75, and so I think that lines up. And I think the question from there is really around their commentary, right? Around what does their forward guidance look like? And I think that keeping everything else equal, equity markets rather pull forward the rate hikes rather than extend it over a longer period of time.
You're expecting a more hawkish message on Wednesday,
yes,
aren't you?
Yes. Yeah, I think they're going to indicate they're no longer going to back themselves into a corner saying we're going to do a specific hike the next meeting. So my guess is they'll keep it wide open, and I don't think they'll limit themselves to 75 basis points. They're going to want to really keep them keep their everything open, all their options open.
So the bond market has obviously been screaming at the Fed.
Yes.
Do more, right? Now maybe they're finally getting the message. What does that mean then for where stocks go from here if the markets perceive the Fed to finally be listening, for a lack of a better description?
Yeah, I think there's no easy way or good way out of this. I think that there is a better way. So I think that, yes, the market will like pulling the hikes forward, but it's overall going to be very problematic for equity markets how this is going to play out. We think that the sell-off has more time and has a lot more in price in terms of going to the downside.
How much more? How much more? I mean, because again, to put it into context for people who don't see you every day, somebody who was negative big picture, made a big call that stocks are going to have a huge rally, backed off of it a few days later. We had a big rally. Now here we are. We've set new intraday lows today, and we're wondering how low we're going to go again. So it's a little bit of context into the kind of conversations that we've had of late and the kind of calls that you've made.
So we look at the equity risk premium as our valuation metric. We think it's super important. If you look at each of the sell-offs in the year 2008, 2018, 2020, the equity risk premium has moved up by anywhere from 200 to 500 basis points. So far during the sell-off, it's actually moved down, meaning stocks have gotten more expensive relative to where rates are. And the reason why is because we've had this massive backup in rates. If you look at credit markets are the widest they've been since May of 2020. May of 2020, the equity risk premium was 100 basis points higher. If you talk to a lot of people in industry, they're talking about the recession risks being very high. I think they're very high. Everyone thinks they're very high. That is not being reflected in the equity risk premium, despite the fact that we've had this sell-off. And so you can see, numbers in the low 3,000s for sure, and that's not crazy at all based on where the equity risk premium should go. The other thing I would say is that one of the things that we're seeing is that as markets go lower, it has a self-fulfilling effect. This is clearly impacting the economy right now, right? Growth is slowing, inventories are moving higher, and the sell-off is sort of happening real time as we speak. And so as you go to lower prices, the growth outlook and the earnings outlook are both going to get worse. So you can't just take a snapshot today and say, where's it going to go? What is the snapshot going to look like, the picture? And not only could valuations move lower, but so could earnings and the overall growth outlook.